So now that tax season has passed, you've probably taken a breather, happy to move on, don't want to look back, right? Unless you extended your return. And you may be extra interested in our episode today because we're talking about tax return surprises that we've seen in the last few tax seasons that many people could miss. So it's might be good to walk through a couple of these, and we're going to share a few that we came across that you'll want to take extra special attention and looking back to see if it might have been missed on your return, because we often see many miss these. This is one we've seen many years in a row here. The double taxation on backdoor Roth contributions, because you're receiving that 1099-R, right? But there's a box there you want to pay attention to if you did one of these, because often it can be double counted.
Absolutely. Yes. So we see this all the time. I know we've talked about this on multiple episodes. When you do that back to a Roth contribution, you've already paid tax on that money that you're using to make your traditional non-deductible IRA contribution that's later converted to a Roth IRA. However, when you receive your 1099-R from the financial institution, it will show taxable amount not determined. And it's going to show, then the next line will say taxable amount. It's going to show the full amount that you contributed and then converted, plus maybe some interest, potentially, maybe, a couple dollars of interest here or there. You've already paid tax on this money. So the taxable amount should be zero, or $1, $2, $3, $5 of interest that may have occurred while the money was sitting there prior to conversion. So you want to make sure you file Form 8606 and that the taxable amount is zero or slightly higher than zero on the front of your 1040. We see this come through all the time where the taxable amount is the full amount of the contribution and conversion. So essentially that means you're paying tax twice on those funds. So we want to make sure that that doesn't happen. Again, not to worry, it can be amended, it can be fixed, but it will be a lengthier process than it would have to get it right the first time.
So our next one is understanding the safe harbor rules and how much overall tax you've had withheld, because there are some rules there that you got to pay attention to related to last year's income tax paid or this year's income tax paid. And many times it's related to estimated tax payments that you're making through the year. And if you're not making those, it's particularly important to understand where you fall towards the end of the year in this calculation.
Yes. So the IRS wants those taxes paid throughout the year as you're earning your income, not in a lump sum April 15th. So if that happens and you owe a large bill at April 15th, you may also owe an underpayment penalty. You can avoid the underpayment penalty a couple of ways. If your bill is less than $1,000, or if you paid in 90% of your tax liability for the current year, or 100% of the tax shown on your prior year return, whichever is smaller. There's one caveat here, however. If your AGI for married filing joint is over $150,000, then you would pay either 90% of current year or 110% of prior year. And this is really important, particularly if you have a business sale or a liquidity event, something where you're going to have a very high income in 1 year. You want to make sure you go ahead and pay that 110% of prior year, avoid any underpayment penalty, because we know you're already going to have a pretty significant taxable event.
And that's something many times we can spot doing tax planning in the latter half of the year, or the fourth quarter, right? In December, we're putting together tax plans to try to forecast the best we can of what that may look like, what you may owe. So that is something you could look at before the end of the year and maybe do something with making estimated payments. Also, employee compensation, we've seen this too, right? Stock vests or stock option exercises and sales. So keep in mind those could come through without enough withholding there to take advantage where you fit with other income that you're earning there, husbands and wives together there. So, or joint filers, I should say, all joint filers taking a look there. Here, and our last one is digging in a little bit to those investments that are outside of your normal types of investments that we often talk about here: stocks, bonds, cash, brokerage accounts, IRAs, and things. This is when you get into some, if you're a small business owner, or maybe if you're invested in some private investments or some unique alternative investments, you'll often receive a K-1, right, Allison? And let's talk about what that is and how you deal with that.
Exactly. So as you said, if you're a small business owner, if maybe you're a beneficiary of a trust or partner in a real estate operation, oil and gas partnership, you're going to receive a K-1 for the income associated with that activity. These are typically delayed. In our case, a lot of times we see them coming in late March. Some of them this year have not even been received. So expect a delay if you are involved in any of these activities. Expect and plan to file an extension. And this year, even in particular, if our clients had the K-1 from their activity, the IRS form to file the return was not even ready. That was delayed. So a lot of those clients had to file an extension. due to, no delay of their own or on their business entity, but simply because the IRS was not ready to receive those returns yet. And good to keep in mind with these, if you file an extension, it's an extension to file, but not an extension of the payment due date. So you want to get a pretty good estimate of what you expect to owe. Make sure you pay that by, April 15th, April 18th, whatever the deadline is that year, and go ahead and make your payment, and then you can finish your return later.
So as we move into our kind of summary and closing points here of how you can deal with these things, I'll add again that, Allison and I are not CPAs, but we are highly integrated with our tax team where we have CPAs on staff here. And that's what, our vision of a good financial planner or financial advisor should be. A comprehensive advisor looks at your whole situation. And that's why we're addressing taxes here, particularly in retirement, right? There's a whole different shift, and you have much more flexibility on how you can handle your tax picture with strategies that we've talked on other episodes. I think the last 4 episodes, really, we've kind of focused on retirement issues. And this one really, it addresses people outside of retirement. But let's dig in a little bit, and we'll just call this last section our whole progress principle, right? Because if you find that you are missing one of these, or that you kind of looking at your tax return and saying, oh yeah, man, I missed that opportunity. How should we address that, Allison?
Yeah. So we've all had a tax surprise. I've had a tax surprise. Chad, I know you've probably had a tax surprise. We see them for our clients. Expect that it's going to happen to you at some point. Don't shoot the messenger. And I'll say that just because sometimes we're the messenger, but also, the people preparing your tax return are trying to do the best job for you. And basically they're writing history. So you're giving them that history. And then, next step is verify, verify, verify. Just make sure that everything that you gave to your tax preparer, or that you put into TurboTax or whatever system that you're using, is correct. And like we mentioned, there were a few things at the beginning. The cost basis, you want to make sure all of your relevant statements were included. Maybe you had a big change last year that needs to be incorporated. Just verify, double check that everything was correct. And then there may be some things that you can do before the tax day deadline, perhaps a traditional IRA contribution or an HSA contribution or a SEP IRA, solo 401k. There may be some options like that to increase the tax deductions before tax day. Ideally, we'd like to know about those before 12/31 of the prior year. There's a few more opportunities at that point, but there may be a few things you could do to lower your tax liability prior to tax day. Also important to keep in mind, if we owe taxes, it means we made money. So taxes are a side effect of earning money. It means you had a high income. Things must have gone well. Nobody likes to pay the IRS more than they need to. We want to make sure that everything is correct. But we do want to keep in mind that this can also be a positive thing, because it means you are doing well financially and money was made last year. Also keep in mind, you have 3 years to amend your tax return. So if one of these things happen after the return has been filed, we find that maybe there was one of these surprises. Maybe you received a late statement. Maybe we find that the back to a Roth contribution was not reported correctly. You can amend the return. Expect a delay with any money that you're going to receive back from the IRS, but it can be corrected. One thing to keep in mind as well, as I mentioned earlier, the IRS has a reconciliation process. So if you missed something, and I will say their reconciliation process is going to focus more on income that you missed versus deductions that you missed. I've never had a client receive a communication from the IRS that they didn't take all the deductions that they were allowed. But you will receive what's called a CP 2000 letter in the mail. And we actually have an episode on this. It was episode 95 with Chad and Grayson on how to deal with the dreaded CP 2000 letter. I know communications from the IRS can be scary. I find the wording on those tends to scare a lot of folks, but it's important to just take a deep breath, see what you need to do. A lot of times it is a miscommunication or, an error in the way something was reported. As long as you have all the documentation to back up, you may not end up owing additional money, or sometimes you end up getting money back from these. That's not typically the case, but important to go back through, verify, and submit any additional documentation that the IRS needs with these letters. And as Chad said, if you want to get in touch with us for a tax return review, or if you have received a CP 2000 that you need help reviewing and figuring out how to address, you can contact us as well.
Yes, we focus on a lot of different tax options. This is the surprise episode, right? The 10 that we've seen over the last few years. We've done many other episodes. You can search our website. There's a magnifying glass in the upper right-hand corner for other tax topics, tax subjects, tax strategies. We've addressed a couple in past episodes. Donor advised funds, particularly if you're charitably inclined. also qualified charitable distributions for retirees that are taking RMDs. So there's many other options and opportunities, but this is just scratching the surface of what you want to look for. And really, it's nice to have a tax checklist, right? Every year going forward to see what you might have had. Just have a folder that you throw everything in through the year too. And hopefully that will help remember some of those things that might get lost in the mail this year that you had last year. As always, if this is your first episode, and if you are not yet a Financial Symmetry client, you could reach out to us on our website with the Talk to an Advisor button. And just put in the comments there, you'd be interested in a tax return review, just having a conversation about what that looks like for your situation to see if there are any areas you are missing. So you can check out many of our other episodes, over 160. You can leave a review on any of the podcast websites out there so other people can find the show. We appreciate you listening and look forward to catching you again in 2 weeks.